Hey everybody, John the Economist here. Really looking forward to this live stream. I think there's quite a lot to cover because there's market volatility all over the place. So per usual, we're just going to hang out a little bit to start, just get some chit chat going, wait for some people to enter and start watching, and then we will move on from there. If you are watching right now, especially on YouTube, you should like, you should comment, you should subscribe, you should do all that stuff because this is a newer channel, and the more that you do that, the more people that watch this later, the happier that I am, because more people are watching my nerdy economic stuff. So all the more reason that you should participate. Anyways, yeah, things have been pretty insane in the markets, in like literally every market too. Commodities prices, this traditional stock market, the crypto market. So I'm looking forward to getting into that. Also, per usual, if you have any questions whatsoever, please comment them. These are a ton more fun when there's more engagement in that sense. Really quick, I am going to just post this around in a couple different places. That's one. That's two. Sweet. All right, we're rolling. All right, so one of the first things that I want to talk about for this stream in particular are commodities prices. And if you're watching this and you decide to not tune in to the video that I will post next week, that's totally fine because it will be redundant. So you're doing your homework if you're watching this live stream and getting this walkthrough on commodities prices. In fact, I've actually covered lessons pretty similar to this in the past more than a couple times. So really quick, and by the way, when I say more than a couple times, I'm pretty sure, yeah, this is from November. So, and I think this will probably be the fourth or fifth time that I've covered this particular topic. So anyways, so we're going to go with a very, a little bit more dated example, but I think one that does a really great job of illustrating the problem. So the first thing that we have here is this, during COVID, right? We had a lot of supply chain issues. People weren't working as much. Obviously, there were just lots of clogs in ports and things like that. So the result was this supply chain crisis where just, not as much stuff was getting to the places that it needed to be, right? Um, the result of this is that, the commodity we're going to use for this particular example is going to be lumber, right? So take a look at this. This is equilibrium price lumber. Okay. So, all things being equal, ceteris paribus, we have, an optimal quantity for lumber. We have an optimal price for lumber. We have demand, which decreases the higher the quantity goes because the more of the exact same thing that you have, the less you value it, right? It's referred to as diminishing marginal utility. If you want to experiment diminishing marginal utility yourself, I would go to an all-you-can-eat buffet. And when you stop eating, that means that the quantity's gotten so high that it's just not worth for you to fill your stomach anymore, right? Diminishing marginal utility. And you have increasing supply as that quantity increases. And that's because if you're being the one to supply it, aka sell it, right, you're going to want to sell higher quantities at higher prices. The thing that reels that in, obviously, is demand. That's how you end up with this equilibrium price. So again, this would just be a standard equilibrium market for lumber. But then let's say you have delayed shipments and less workers and all that stuff that we dealt with during COVID. And as a result, you get a decrease in the supply of lumber, right? So you had your original supply and then you had your supply shifting left because it decreased. The result is that the quantity decreased and therefore the price increased, right? There's less quantity to go around. The demand remains the same. Therefore, prices go up. Cool. Also, now that I'm seeing that a couple people are watching, go ahead and leave some comments with some questions. I'm happy to answer any of them. Additionally, if you want me to do any chart requests, Like if there's any assets that you hold that you want me to take a look at, kind of do, some analysis on, I'm happy to do that. Not something I've really been advertising a ton when I do these live streams, but they are a lot of fun. So yeah, if you have any holdings whatsoever, be it crypto or stocks or whatever, we could do a little bit of technical analysis on it, something to spice the stream up. Anyways, then let's say, due to both increases in the money supply, changes in taste and preferences, we have an increase in the demand for lumber. So the COVID example of this was that people were renovating their houses or moving at a really high rate and super abnormal rate. So at the same time of lumber decreasing in its supply because of the supply chain issues and less people working, we also have the other effect of demand increasing because people are trying to redo their houses and move. So the result was you had, and this, hopefully the color coding helps here, right? You have this shift left in supply because we decreased. You have this shift right in demand because we increased. And then you have this new equilibrium quantity. And you can see this quantity went back to pretty much the quantity that we had pre-supply crunch conditions. But what changed was the price skyrocketed, right? So there's new quantity coming in to meet that demand, but that's at the cost of price increasing substantially, right? So let's put this into practice, and I'm gonna actually show actual lumber commodities in a second, but just for the sake of this presentation, this is what it looked like back when I was doing this. Was you had just this massive run up in the price of lumber, right? And the reason why, by the way, this run up happened and then this decrease is because commodities are what we refer to as perfectly competitive markets. So I'm gonna just scroll up here so that we can draw something. What I mean by perfectly competitive is you have kind of the scale, right? And the scale is perfect competition and monopoly. And what this means is for perfect competition, the goods are homogeneous. They're all alike. There's nothing to differentiate them. And there's a lot of people in the market selling that homogeneous good. And then, there's a whole spectrum here where maybe the goods are a little less homogeneous and there's not a ton of firms making it. A great example, maybe like pants, right? Like not all pants are the same. Some pants are higher qualities, some pants have better branding, et cetera, et cetera. But it's not a monopoly, right? Nobody's monopoly on pants. There's just a variety for you to choose from. So as a result, the producers get to command the prices a little bit more. And then as you keep going, right, like maybe this is, an oligarchy, and then you get to a monopoly where it's just one producer of one unique good. They get to set the price, they get to make the rules, right? So in commodities, we have perfect competition. And what perfect competition means is that because the goods are homogeneous, because there's a bunch of entrants in the market, economic profits will trend towards zero. Now, this isn't business profits, right? Business profits are your revenue minus your expenses equal your leftover money, which is your profit. Economic profit is when there's something else that can bid away what you're currently doing. There's an opportunity cost to what you're currently doing where you could be making more money doing something else, right? And economic profits and perfect competition won't always tend towards eventually there's probably something else you could be doing to make more money. But what happens when you have these massive run-ups in price then is that you get supernormal profits in a perfectly competitive market is what we refer to them as. And supernormal profits in a perfectly competitive market result in more entrants into that market because they're chasing the supernormal profits, right? So imagine, like you're a trucker that delivers, say, food primarily, or, maybe like industrial equipment or something like that. But you see, there's this huge supply crunch with, a really basic commodity like lumber. So because of that massive price increase, the supernormal profits that are to be earned, potentially that trucker gets bid away from doing those other things that are more closer to an equilibrium to go chase these supernormal profits. With that entry of so many new firms chasing these supernormal profits, it will eventually drive price down, right? So you have this massive run up, and then you have price eventually driven down. And by the way, this price driven down doesn't happen overnight. It happens over the long run. And what the long run means is that there's enough time elapsed for people to adjust their behavior to the current market conditions. For producers, that means having enough time to change your outputs, right? And your variables. And for a producer, that just means, enough time to adjust your buying decisions. Those happen a lot quicker usually than production side, but I digress. But over the long run, these eventually should trend towards back that stable equilibrium. So, and also, we're going to do this again, by the way, for those that were at live stream. Polar Seltzer. I drink this orange vanilla flavored, 0 calorie, 0 sugar Polar Seltzer multiple times a day. I probably buy like a crate a week. So Polar, if you're seeing this, I drink your product and I am giving you free advertisement now. But if you want additional advertisement, you should contact me. Delicious. Anyways, so let's take a look at lumber prices. And this is what I want to illustrate here, right? So this blue region here is lumber prices from this bottom in October of 92 to this top in April of or June of 2018. What do you notice? Lumber existed in the same price range, 40% price range for over 2 decades. Actually, my math is bad. Over 3 decades. For 30 years, the price of lumber stayed just chilling in here, just bouncing around in this like 40% thing that's going on, right? So what this suggests is we could probably say this is super normal profit opportunity for lumber, right? Which means that I don't think it's likely that we're just going to have this continuous run up because it's a commodity. People can enter and start selling lumber themselves. If they see this crazy run up and all this profit to be made on lumber, they're going to stop doing whatever they're doing and start getting involved in the lumber market. More entrants, more supply, it's going to drive down price. So, it might do this for a while, but eventually it's going to come back down to reality. And I think the data very clearly supports that. And if you want to zoom out here, right, like this is lumber all the way back to the 50s. It doesn't do much, right? And I mean, at this rate, a lot of this increase, you could probably just account for, like inflation and just asset prices generally rising with time, right? It's not like you thought wood was like a crazy, insane investment to make, right? Now, why I'm saying this is because maybe you guys aren't super concerned with lumber. I doubt you're super concerned with lumber, but everybody's talking about wheat prices right now. I mean, look at that. Let's just zoom in on this like daily, right? The short term. Wheat prices are up top to bottom like 76% in 3 weeks. That's insane. It's calmed down a little bit, right? But I mean, this is a crazy run up, and the crazy run up is because there is a decrease in supply with the sanctions that we put on Russia, and as a result, right, no fertilizer, no wheat. Those are huge exports that most of the world relies on Russia for, right? And as a result, we had this massive run up. But again, more supply is going to come in over the long run because it's a commodity. There's no secret sauce to creating wheat. You just make more wheat. So as soon as the long run happens and we have time to adjust these market conditions, where, again, it's not going to look like this, right? It's going to probably look like that, right? So, and, I'm not saying to make any, like, I'm not saying to long or short this particular asset. I'm just simply saying, like, economics, perfectly competitive market with a homogenous good. This is going to come back down to reality. And same thing that we did here. I mean, look at wheat. And this one doesn't have quite as crazy as a time frame to deal with, but wheat's basically been in the same range from 2016 to now, right? And again, it's just because if there's super normal profits to be made, more firms are going to enter the market. All right. There is lumber. There is wheat. Let's talk about the one that everybody's probably the most concerned about, which is oil. And again, oil has been roughly in the same price range, 60% price range since 2015. And again, it's supply and demand, right? Like it has its ebbs and flows still, right? And you have two outliers when literally nobody was driving because we were all locked in our houses for several months. And right now, when we cut off exports to a massive oil producer. The result, more firms, or rather, sorry, with the decrease in demand, there was probably less firms, but those firms, came back into the market once they saw that there were profits to be made. And then over here, exact opposite, right? More firms are probably coming in because of the fact that they see this super normal increase in oil prices. So again, right, for the third time now, we're probably not going to see that, right? I'd say it's unlikely that oil prices look like that. What we're probably going to see is something like this and then back down to reality, right? And oil prices have been this bad before, by the way. I mean, just zoom out here. Let me go to the weekly chart. I have data up to 1984. They've been lower, they've been higher, but for the most part, they have an equilibrium price. And we're doing financial analysis right now rather than economic analysis. We're just taking the economic theory that I just taught and applying it here, right? See, I have a few more viewers that have come on recently. Again, if you have any questions, please feel free to leave them below. If you have any assets that you hold that you would like me to analyze, I'd be happy to do that as well. I think that doing some TA live on the fly would be a lot of fun. So I digress. So that was kind of just the main lesson that I wanted to get across with these commodity prices running up, because I know a lot of people are going to get excited. Maybe you're considering buying it, and this isn't financial advice or telling you what to do. But after these massive run-ups like this, and it's signaling to people everywhere that there's some super normal profits to be made. And if that's the result, then eventually more people are going to enter, more people are going to produce. It's going to increase the supply, and it's going to just slowly come back down, right? Now, don't be wrong. I mean, we're probably in for like a good, 3 to 6 months of pain here, right? Like gas is going to be expensive for a while, but in the long run, when firms have the ability to adjust their outputs towards the changing conditions, they're going to enter this market. They're going to create more supply. The demand's going to remain the same, and prices are going to come back down to something that people are a little bit more used to. Okay. Pretty confident of that because, the laws of economics are pretty reliable. I can't tell you how long exactly it's going to take. I'm just going to tell you that it's not just going to be the sustained increase for years and years and years. That's not how commodity prices tend to work because of the fact that they're perfectly competitive markets. I feel like I've drilled that one home enough. We're already running on 17 minutes of me talking about super exciting assets like oil and wheat. Super fun stuff. So we'll move off of that and we will get on to crypto and stocks and all of that other stuff. Again, for those watching, leave comments. Makes it more fun for me if I have things to respond to and assets to analyze. Again, if you have assets that you hold that you would like analysis on, I think that would be a fun thing to do. Demand will decrease substantially as firms shift towards green tech, partially because of this disruption. I definitely think that's true as well, right? And both things can be true, right? Like, drawing this out. Here's your supply. Here's your demand. Now we're going to change colors because we're fun like that. Oop, not for the demand. Go back. Cool. So what we might see is, this decrease in supply that's going to raise prices, right? It's going to raise prices from this P up to that P. And then additionally, people will adjust to those market conditions. and your demand might decrease because they'll move to substitutes, right? And that's something that can change demand is substitutes in the market. So a substitute to gasoline would be green energy, right? And then demand decreases, and then, same concept, right? You got a new demand curve on that new supply curve. Maybe price returns to normal and your quantity for oil demanded decreases substantially. Probably not as substantially as what this graph is visualizing, but hopefully that makes sense. So, there's several things, right? It's just over the long run with commodities prices, both suppliers will have the ability to adjust their outputs and buyers will have the ability to change their taste and preferences and buying behavior. Both things can be true. But what I'm trying to get at here, and we'll go to oil one more time, is as long as there's super normal profits to be made, there will be people entering this market. And as soon as there are not super normal profits to be made, and this comes back down to reality, and maybe it does this and then it comes down, maybe it just stays stable and then it comes down, maybe it just starts coming straight down from here. I'm not sure. But what I know is that as soon as those super normal profits are identified, firms will enter, they'll try to sell at those super normal profits. And as soon as that comes up back to reality, they'll start looking for other things to do over the long run, right? Robbie, what's up, dude? I'm here to learn. I truly know nothing. Miss you. I miss you too. I'm home next week. I don't know if As We Divide has any shows going out in the next 2 weeks, but if you do, you should let me know about them. I'm going to Hannah's show opening for Fit for a King and Silent Planet at St. Andrews on the 21st. Yeah, just if you want to come through to that, you definitely should, because cool music, cool people. You can say what up to me. And again, now that we have a couple people watching, if you have assets that you hold that you would like me to analyze, please toss them in chat and I will take a look. Thought on the yield curve flattening, recession in the next 12 months. Yeah, I mean, look, and this is, I titled the last live stream that I did, "Are we in a bear market?" Right? And I mean, the Dow Jones is, and again, what stock market prices are doing doesn't necessarily imply recession, but we have the Dow down substantially. We have the Nasdaq down substantially. We have S&P 500 down substantially. We have gold rising. We have oil rising. We have inflation rising. I'm not feeling super good that we can consider this, a non-recessionary period. I think a lot of people will say that, our exit from COVID was the end of a recession. But I'd say you could kind of consider it one long recession. I think the history books in 2030 will consider, 2020 to 2020, whatever, a long recession. Because the only reason why we, weren't like fully recessionary during COVID is because we did this to our money supply, right? We just made money printer go burr and everybody was doing a little bit better because, we got to enjoy all this fun time right here before inflation really started to kick in, over in this range. So I digress. Let's see what else we got here. Only thing I'm holding is INTZ for the memes. Lost all my money with shitty options. Might get back once theft return kicks in. So yeah, I don't mess with leverage. There's a lot of reasons not to mess with leverage. And think about this too. I spend all day staring at these charts, and I have several, degrees in economics and finance and stuff like that. I don't screw around with leverage. But let's take a look at INTZ. I'm not sure what this is. Intrusion Incorporated. Oh, ouch. Okay. So this is purely technical analysis. I don't know anything about this company, right? We're going to pull up some key moving averages here. So this particular asset is beneath its 50-week moving average. It's a 100-week moving average, which they just this is referred to as a death cross. and the 200-week moving average, which you don't see assets dip below their 200-week moving averages crazy often. So that's kind of scary. That's seems to be a macro, a very big macro lower high. All right, so you could draw potentially a downtrend off of that. Right. So, I mean, what you'd honestly like to see is, potentially this comes up and starts moving back in this direction, because we do have bullish momentum here, right? Like you have, I don't know what's going on with my chart in this range right here. It's just giant blue blob, but I digress. But what you do have is you have a low, a high, a higher low, a higher high, a higher low, a higher high, and then we'll see what this low does, right? This comes down and prints a lower low. This might, start doing something like this. If it holds here and prints a higher low and starts curling back up and puts a higher high, then bullish momentum is still maintained. Now, this is a very long-term potential, play that we're seeing here, right? But yeah, I mean, the fact that this seems to be kind of holding, long-term support right in this area here is a good sign, right? You haven't gone to this low right here at $2.25. It looks like the lowest you've gone is $2.86. So yeah, I mean, if this can even come down, this can come all the way down to 225 and still print a higher low, and you'd be in good shape, and you'd probably be looking to see if you can get a higher high off of this. This looks very blow off toppy though, and that's never any fun. You don't like blow off tops; they're a bad time. But yeah, that's all I got for this. Again, I'm not sure what this company is or what they do. Intrusion, I'm not sure. But yeah, there's a slight amount of TA. So like I said, if this starts curling back up and it breaks this high here of 29.75, bullish structure still maintained. But what you're really looking for is potentially breaking this kind of downtrend here and making its way up. Also, my phone is like buzzing off the hook, so give me 1 second while I throw do not disturb on for an hour. Cool. With daily balancing, Jim Cramer's portfolio is down 11%. So I feel for people's 401ks, but it also supports people learning how to manage. Yeah, I mean, that's the problem. Is most people don't manage their portfolios; they just invest, and that's totally fine. And if you're in it for the long game, that's 100% fine. And if you're in it for the long game, then what the price is doing today or tomorrow or next week doesn't matter in the first place, obviously. But yeah, I mean, this is why we trade and rebalance portfolios and all of those things, is so that we can be a little bit more risk off in situations that call for it, right? I coiled up some of my profitable altcoins into Bitcoin because, in reference to the other altcoins, Bitcoin is more risk off. It's not a risk off asset completely. It's just more risk off than all the other small cap altcoins that, could potentially be going crazy at any given moment. So, and, because of that, my downside isn't as ugly as somebody that, was YOLOing into, any other potential altcoin that's now down probably 70, 80% from their tops. And again, so I just, not really knowing a ton about INTZ, I did, analyze it for Anthony here. If you have assets that you hold that you'd like to see some analysis on, I am happy to provide that. I have no idea what they do. Some medical thing that my friend said could be solid long term. Yeah, I mean, it could potentially be a solid long term hold, right? You saw bullish structure, bullish momentum there. That like blow off top looking thing didn't look too fun. But that, in the long game, that doesn't matter anyways. So I wouldn't be super worried about it. Cool. Got through all the comments there. Gonna take a sip of my amazing polar seltzer from this amazing company that should give me money to drink their seltzer that I already drink a lot of. I'm not gonna stop this, by the way. Like every stream, I'm just gonna shamelessly ask for an endorsement. It would save me so much money. I buy like 2 cases of this stuff a week. All right. So because I'm not seeing a ton of comments requesting assets, I'm going to take a look at Bitcoin because it's everybody's favorite asset, right? Right. Let me get rid of my ugly moving averages. So I'm not gonna lie. I've been getting kind of, I don't want to say chewed up outright trading, but the fact that this has been a hard line in the sand, and it's one that I think, we might be breaking when we keep printing these higher lows. It's tough to trade. At least I've been finding it tough to trade. Now that I see this pattern here of just consistent rejection at this $45,000 range, maybe I'll be able to trade it a little bit more reliably. But right now I've been kind of off on it. I've tried Liquid Death. I would be interested in giving them another try. They're just more expensive than Polar, and I'm frugal. So, when it comes to sparkling water, you're only going to go so far. But I definitely need to try them out a little bit more. Oh, there we go. Adam asks for Luna. Adam, if you'd like me to analyze this versus Bitcoin as well, I'd be happy to do that. So it's no secret, Luna's been crushing it as of the past couple of months here. And what's great about Luna as of late is that it's showing relative strength, right? Meaning that versus all of these other assets that have been depreciating a lot, Luna's just been crushing it. So let's take a look at some long-term moving averages here. So first of all, I mean, bullish structure is clear as day, right? I mean, you have a high, you have a low, you have a higher high. I mean, it barely looked back here. You have a higher low, and now it looks like you're trying to print for a higher high, right? So let's introduce these moving averages. So I don't know how old Luna is as an asset, but I only have up to the 50-week moving average, unfortunately. But what is clearly obvious is that it's made it above its bull market support band. It's come down, and I don't know if I'd call this a hold of support because it's beneath it here, and we have closes beneath it, but we're headed back up anyways. So really volatile. And again, we're in a bearish market, and we also have yet to print a new high officially. So what I would personally be looking for, let's go back to the daily chart. Oh, that's a great hold. That's the hold of the 200-day moving average. So and this you could probably call a double bottom. Maybe I'd give that the benefit of the doubt to call that a double bottom. What you'd look for here, because right, we're seeing this rejection at this previous high, and that's where I'd start to kind of get a little bit iffy about this momentum here. Another thing that's definitely worth taking a look at, let's pull up the RSI here. So this is the relative strength index. This shows the strength of the moves proportionate to the other moves, right? What you look for with the relative strength index is bullish and bearish divergence, right? What that means is when what the price does diverges from what the RSI is showing you. For example, we have a bearish divergence right here. What that means is that RSI put in a high, price put in a high. RSI put in a lower high, but price put in a higher high, right? So while price put in a higher high, RSI put in a lower high. On the daily chart, I tend to consider that a pretty significant indication that the momentum here could be running out. On top of that, we're failing to break past this previous high here, right? And additionally, and you don't want to use RSI like I'm about to use it, but it's worth pointing it out. You have a high here on the RSI, and that's a lower high here on the RSI when they hit the exact same price, right? But this is a longer swing here, so that's not as reliable. What you'd look for Luna, if you want to see continuation, is you want to get above this line, you want to come back down and hold this support, and then you want to work your way back up again, right? So above that high, come back down, hold the high as support, and then start moving back up. That confirms that, and you should it's a great setup for, if you want to make an entry or something like that at that point, right? But personally, I would not be adding. This is not financial advice. Personally, I would not be adding to my Luna pile until I see that, right? Because what I could see here is a stall out, continuous rejection, and then go down. Or this could break this, but maybe RSI puts in yet another lower high. And then eventually reality check is going to come in. And let me just illustrate what RSI can tell you about this whole bullish bearish divergence thing if you don't believe that it's a reliable indicator, which why would you believe me, right? I'm just some random dude on the internet that's talking. Right here, great example. You have a high and a higher high on price. You have a high and a lower high on RSI. That's bearish divergence. And if you've been paying attention to Bitcoin's price, there was a hell of a lot of follow through on that bearish divergence. And even more significant example, I would argue, is this legendary top from early 2021. I mean, look at the RSI here, right? You have, actually, let's look at price first, right? Looking at price, I'm going to get rid of all these crazy moving averages just so it's a little easy to see what's going on. You have a high, a higher high, a higher high, and a higher high, right? 4 consecutive higher highs on price here with Bitcoin, right? We can all see that. And on RSI, we have a high, and then a lower high, a lower high, and a lower high. Bearish divergence, right? Now, this is just continuous confirmation of that bearish divergence, right? So anybody that trades bearish divergence, frequently, they might take profits on this first one, and they might miss out on that all-time high. But this is, 59K versus 64K. What's the big difference, right? If you're looking to re-enter it after a dump, which we got. So again, continuous. And by the way, I mean, this was the true nail in the coffin there, is now we have all this bearish divergence, and then it's met with a price actually putting in a lower high. And that was just confirmation that it was bear market time for this particular scenario. They don't always play out, the same every single time, but, I mean, you're seeing it here too, right? You have a high, higher high, higher high, and then higher lows in RSI, and that eventually led to a correction, right? It's not rocket science. I'm not saying it's incredibly reliable, but for an asset like Luna, that, again, like the rest of the crypto market's in a bear market, there's no secret. And Luna has, in this bear market, when did this bear market start? November of 2021. Luna's up 180% in a bear market. It's struggling to break its previous high, and we're witnessing some bearish divergence, right? So just worth taking a note of. I'm not trying to say what you should or should not do. I'm just simply, analyzing that particular asset and saying what the technicals are showing me here. Cool project, though. We'll see what happens with it in the future. Volume looks really good right now, but we'll see how that handles. Back to Bitcoin. So, speaking of market structure here, right? So, we had just this relentless onslaught of downtrend that felt like it would never end. The RSI indicator is interesting. I've never used it much. RSI is because I'm a swing trader, right? I tend to try to trade these longer term moves the best of my abilities, and RSI I think is incredibly reliable. And I start paying attention again when it breaks an RSI downtrend, right? That's why I have these blue lines going across here, is because you get a break of that RSI downtrend. Maybe it's time to start paying attention again, or maybe it ends in disappointment. You don't know. So Bitcoin's in a really weird spot for me. I really, on the one hand, we have consistent higher lows. That's awesome, right? We like consistent higher lows. Higher lows means that we could be having some bullish momentum here. On the downside, we cannot break past 45K. which is definitely alarming. And then we are also underneath some pretty key moving averages. We're kind of between a rock and a hard place, right? Because let me pull up the logarithmic regression. This is a lot of lines, so I'm just going to go over here quick. Okay. So we are beneath the 20-week moving average and the 50-week moving average. We are above this logarithmic regression band as well as the 100-week moving average. And we've been, give or take, bouncing around between these guys up here and these guys down here, right? I mean, minus a few percent in either direction, right? Try to make it up here, fail. Go visit this range again. Try to make it up here again, fail. Come back down. So it's really tough because until I see a decisive break underneath here or a break above here, I can't really say, bullish or bearish officially. We've definitely been bearish, and we are clearly in a bear market. We have been for quite some time, but that's the thing is, right? This looks a whole lot different than this, right? This is down. Consider this sideways. Consider this whole area sideways. This was down, clearly down. This might be sideways. We're going to find out. So again, we have these lower highs that are getting, or these higher lows that are getting printed, sorry. But then we can't break out of this 45K region. Now, some people might say, oh, well, if you have consistent higher lows, and then you just have like a standard flat resistance level that you can't break out of, that's an ascending triangle. Ascending triangles are bullish market structure, but that's all statistics. That just means it breaks up to the upside more often than it breaks down to the downside. That doesn't mean that's super reliable. And we could get up and then another rejection and then another higher low, and then we break out, and the rest could be history. But here's what I want to caution people out of. We're going to go weekly here, if that's cool. And we are going to pull up our moving averages, but we're not going to pull up our log band. This is what I see, and this is what I'm really concerned about. And I'm keeping a very close eye on, and I'm trading very little until I see this either happen or not happen. You are under the 50-week moving average, and you're struggling to break that. And we just kind of seem to be like consolidating into like just, a tighter and tighter spot as this 100-week moves up and this 50-week curls over and down, right? These two might cross eventually. We'll see. And the price just keeps getting smushed between it. Now, I want to go back to 2017, 2018. You're under the 50-week moving average. You have this rally to the upside that failed. And look here. This is the part that concerns me. You have lower highs, or higher lows, excuse me, right? So these are getting bought up, right? In the same way that our current market structure is getting bought up. It's getting higher and higher each time that we visit these new lows. It's getting squished between the 100-week and the 50-week. There's a little bit way more breathing room this time around with the 50-week, but the concept's the same, right? 50 weeks curling over and heading down. There are 100 weeks moving up. You have these failed rallies. You have these higher lows that keep getting printed that kind of keeps the hope alive, right? And then on the week of November 12th, 2018, the floor fell out. And we went and visited the 200-week moving average. And by the way, when it comes to moving average analysis, I follow a guy named Ben Cowan. He is brilliant, and I try to give him a shout out. Not that he owns any kind of intellectual property as far as moving average technical analysis goes, but I do think he has a lot of really profound things to say, and I definitely borrow a good chunk of his perspective on moving averages for my own analysis. Anyways, so this is what I'm concerned about, right? I'm not saying it's exactly the same. There's definitely quite a few differences, and the macroeconomic environment's entirely different. And we frankly don't know how large institutions like countries plan on reacting to Bitcoin just yet, right? So because of those things, and because we're under the 50-week moving average, and because the 50-week and the 100-week keep moving closer and closer together, I'm afraid of this outcome. Now, I have some cash just in case this does happen, and I have a plan for in case it doesn't happen. But what I do know is that, if this happens, there's going to be a ton of people that are not ready for any such scenario. By the way, let's take a look at the 200-week moving average to see how low we could potentially go if that was the case. It'd be about $20,000. I think personally that this confluence between the logarithmic regression rainbow and the 100-week moving average is where I'm eyeing for a bottom. But if we capitulate, right, like we probably will, at the very least visit this band at $25,000, and at worst visit this band at $18,000. But I think if we do fail to hold the 100-week, then probably the 200-week will be there to save the day. Don't know for sure, obviously, but I'm saying if the floor does happen to fall out, that's probably what I'd be looking for. Okay, let's get all the crazy analysis. I'm going to go back to a little bit of short-term analysis here too. Right. Here's the bullish case, right? So I just gave a bunch of bearish case and why the floor could fall out and why I'm a little bit afraid of this, but still paying attention to these higher lows that happen. The bearish case, or the bullish case rather, for me is going above 45K and then hanging out there a little bit to make some support, and then making a move probably to 53K or so, right? And if we can just break it and get into the mid 50s, I'm bullish at that point, right? But I haven't seen that yet. I don't know if we're going to see that. The other thing that's kind of bullish case is the fact that even on a macro scale, we haven't printed a lower low yet. We've only been printing higher lows, which is pretty bullish. And then on top of it too, out of this range, we can still go to 30K and it's still just, we're just bouncing around in a range, right? Got a nice McDonald's pattern going on, right? Because when the market does this and dumps, that's where you're going to go apply for a job as McDonald's. But at the end of the day, we're just locked in a big range. It's just all we're doing. And in a lot of ways, I'd consider the fact that we've been in a bear market since this top. I know we put in an all-time high since then, but from an RSI perspective, from a sentiment perspective, from a momentum perspective, this was a low volume top. There wasn't a whole lot of excitement, right? I'd say this top was significantly more significant than the second top. So we're just range bound, and this might look like this, and then we start heading up again, or maybe it looks like this and we start heading up again, or maybe it looks like what the S&P 500 did in the 2000s, and we actually print a lower low and really scare the bejeebus out of a bunch of people, and then we start moving up again. All of these are options, right? And price might go down before it goes up again, right? I get that's a very generic thing to say, but I'm also saying that you probably should have a plan for each, and you probably shouldn't be too panicked, right? Nothing about this chart glares at me like it's doom and gloom and it's the end of the world by any means. It might actually be the end of the world, but as far as Bitcoin's price chart right now, I really don't have too much to be concerned about. Let's take a look at Ethereum. I haven't taken a look at Ethereum from a TA perspective in a while. Bitcoin and Ethereum I just kind of dollar cost average into. So same story to tell here though, for the most part, right? And Ethereum's down more than Bitcoin's down, but it's still just chilling. And maybe even for Ethereum, you could potentially say the setup is maybe, like, I don't know, it's probably closer to a parallel triangle than it is like a descending wedge pattern, which is just a very indifferent setup. So I don't want to make any judgments here, but I think the price target still for Ethereum is $10,000. And I originally thought that price target was probably going to happen at some point, like midpoint, this year of 2022. My guess was Q1, Q2, 2022. I wasn't expecting, a bunch of geopolitical nightmares and macroeconomic nightmares to happen within that time. So maybe the recession slows that down a bit. But like, I don't think there's any reason to believe that we're headed into like a multi-year bear market that is really just going to depress a bunch of people. I think there's plenty of reasons to be optimistic still here, and I think that we'd have to break some pretty significant price levels for that to change, for me to change my mind on that. Because I think this was a pretty scary blow off top scenario, but this looks a lot more tame to me. And again, just like Bitcoin, I feel like we're just in a, oh God, that's horrible drawing skills. I feel like we're just in a giant horizontal range, and maybe we visit the top of it, maybe we visit the bottom, maybe we visit the top again, maybe we visit the bottom again. But one day we're going to break out of this range, we're going to hold a bit of support, and then we're going to head up. I've gotten out of crypto. I had about 1,000 in. Do you feel like it's a good time to get back in? I can't tell you whether or not it's a good time to get back in. But what I can say is we're under some long-term moving average. And this is the main thing that I'll tell you. And this is my strategy, and this is what I personally do. And I do some trading, right? And I've been open about the fact that I do some trading. But at the end of the day, we have this giant logarithmic regression rainbow. This logarithmic regression rainbow encapsulates the price of Bitcoin's entire history and regresses it into all of these different lines, right? Right. So here's what I know is the shaded region down here is personally my buy zone. Why is it personally your buy zone, John? It's because the vast majority of the time that Bitcoin is near a bottom or just spending time ranging, it's in the shaded region, right? We spent this whole time in the shaded region from October to February. October 2011 to February 2013, 2 years in the shaded region, right? Then we spent, oops. And we spent January of 2015 to April of 2017 in the shaded region. By the way, when we're not in the shaded region, we're doing all the fun stuff that everybody gets excited about, right? So that's something to note. And then most recently, we spent November of 2018 to December of 2020 in the shaded region, basically. We broke out of it a little bit here and we failed and we came back down. Point being, we're in the shaded region again. And when we're in the shaded region, it's not a horrible place to start buying. And you could be like me, where maybe I'm buying X amount of crypto per month in this part of the shaded region, and then I'm buying X more percent crypto each month in the shaded region, and then like this is like the kitchen sink region, right? Because and in Bitcoin's entire history, we have broken out of this purple region once, and that was the COVID crash, right? Which, like, relatively speaking, this is the best buy for Bitcoin you could have ever had. So should I just dollar cost average? I don't know what you should do, but I know that I personally dollar cost average, and I dollar cost average heavier and heavier. The lower that this goes into the shaded region, right? And look, I mean, dollar cost averaging works all the time for everybody, basically, right? Like, if you believe in the asset that you're investing in, then you should take a percentage of your income every month and toss it into that particular asset. And if over long periods of time you expect that asset to appreciate, then you will never regret the years of dollar cost averaging that you did beforehand before it appreciated, right? The most successful people in crypto right now are the people that waited until things got so ugly that nobody wanted anything to do with the asset whatsoever, and then they just dollar cost average. That's if you consistently execute on a dollar cost averaging strategy on an asset that you think has fundamental value, you'll probably be in good shape. It's the people that get out because the market gets boring, or get out because the market looks scary, or lose interest and get bored and find reasons to not stay consistent, right? It's like exercising, right? Like if it's great if you lift weights really hard for a month and you diet really hard for a month, but if you stop doing those things, it doesn't matter in the long run. But it maybe, you lift weights just consistently, an average okay amount, and just eat a slightly healthier, but you consistently do that for your whole life, you're going to be in significantly better shape than if you just threw the kitchen sink in for a month and lost interest, right? So that's just like, again, not telling you what to do, not giving financial advice, but generally speaking, if you have conviction on your asset and you think it's going to appreciate with time, what does it matter what the price is doing today or next week or what it did last month, right? I have this nice little rainbow, very aesthetically pleasing, to help me realize kind of where we are based off of historical data and what our downside risk is, right? And from there, I just dollar cost average accordingly. And right, if we break down into this region, I'm going to dollar cost average more. And if we break down into this region, I'm going to dollar cost average even more than that, right? Thanks, I appreciate it, Nate, and I appreciate you stopping by. One thing that I really enjoy about doing this is that it's mostly music friends that are popping in to hear me babble about finance and econ. So I think that stuff is cool. We're getting near the hour mark. Let's see. Do you have any inputs, thoughts on mutual funds? Yeah, I mean, mutual funds, obviously, like, it's not going to be right. It's not going to make you a ton of money in a short period of time because it's not risk on. Mutual funds are very risk off, right? They tend to be, just some very low volatility, whatever that means in 2022 when wheat prices can skyrocket 70%. And Facebook can trade like a penny stock. Where's Facebook? It's so fun to make fun of. It's so easy to make fun of. Like, guys, this is a multi-billion-dollar company, and it's down 52%. That's insane. Anyways, yeah, like, that's retirement stuff. You should consider it savings. Well, one, naturally, you're probably going to be dollar cost averaging into a mutual fund or an ETF or a 401k or an IRA or whatever. Anyways, right? That's just naturally how those things work because they're usually employment based. But you should consider it savings for retirement. And I promise you that barring nuclear apocalypse or a giant meteorite or aliens or something, I'd say there's a very good chance that your mutual fund that you're currently investing in when you're 70 is going to be at a much higher price than right now, right? So, that's how I consider any of this low volatility, slow growth stuff is just dollar cost average, and just keep dollar cost averaging, right? And if you plan on using it short term, then I don't know why you'd be putting into a mutual fund, right? It's long-term retirement stuff. Oh, like, I mean, it's just talk about volatility, right? Because this is what, by the way, this is what the SEC claims on why we can't have a Bitcoin ETF, and like why crypto is dangerous is because they want to protect investors, right? Want to make sure our investors are protected from, losing a bunch of money and getting scammed and blah, 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 blah. I'm sorry, but like, Facebook's done this more than once, but it's doing it more often because our money supply has ruined everything. But they're trading like penny stocks. Like, what's Facebook's market cap? Market cap. $540 billion company, right? So that means that back at its top, it was about $1 trillion company. Hopefully my math is right there. Yeah, so it's like $1 trillion company at its top here, right? So $500 billion have been liquidated in 30 days. Do you guys understand how insane that is? The SEC, oh, we got to protect investors. We got to make sure that they're not investing in anything that's, too sketchy. We can't have a Bitcoin ETF because it's really sketchy. And it's $500 billion wiped off. And like, it's fun to make fun of Facebook, but like, there's Tesla, like, right? Several $1 trillion company. It's down, Oh, was I looking at the daily chart for, oh, I sure was for Facebook. Sorry, excuse me. It wasn't 30 days. It's been 100 days. Still, $500 billion liquidated in about 100 days. Tesla, more the same. Right? We're down, it's about $1 trillion company. We're down 33%. So $300 billion has been liquidated in the past 80 days for Tesla. Like, guys, that's ridiculous. Like, so when everybody says Bitcoin's risky because it's volatile and they want to protect investors, so we can't have a Bitcoin ETF, just keep in mind that, like, while Bitcoin is assuredly flushing out, a good $500 billion or so from its market cap over the course of a few months, so is Facebook. So is Tesla, right? These blue chip companies that everybody looks at as like, ARK Invest, right? ARK's ETF. Oh my God, it looks like the tech bubble. Like, it really does on a short term, right? Like line this up, this daily chart to the tech bubble on a weekly chart. I guarantee you they will look so scarily similar, right? You have a literal like blow off top looking scenario where the asset has appreciated 400% in a matter of, it's March 20, January 20. Actually, wait, they make tools for this. And I'm just going to sit there and do it in my head in front of you guys like I'm moron. About a year, right? It's gone up 400% in a year and then down 64% in the year or so that it began its downtrend. And it's ARK ETF, market cap. All right, not available because it's an ETF. I assumed as much, but just wanted to give it a try. Anyways, ugly, right? Let's go take a look at the Nasdaq weekly chart. I mean, looks an awful lot like the tech bubble, doesn't it? Blow off tops are bad. You don't want to blow off top. You know why blow off tops are bad? They're a lot of fun if you know how to, sell, but everybody thinks that they do, and then they don't, right? The reason why blow off tops are bad is because this blow off top began in March of 2000, and it didn't recover. Let's actually draw a straight line here. I mean, it didn't recover until like literally 2016. So like there was somebody, there is somebody somewhere that bought right here and was down on their investments for like a decade and a half. Crazy stuff. And I do want to draw one similarity here that I think is interesting, just as an economist. We're going to go to the Dow Jones. So the Dow Jones saw the blow off top that was similar to the tech bubble because it was the, only major index at the time during the Great Depression. So right now we're looking at, 1921 through 1932 or so, clear blow off top. And just what I think is interesting is like you do have kind of these scary bear market periods on it. It's just, you can kind of see it, right? Like, this was a pretty significant dump, about a 17% correction. This was pretty ugly, about a 10% correction. No, this isn't all that fun, about a 10% correction, right? This isn't super fun, about a 10% correction. But the floor really fell out, you know, coming into the Great Depression. But I just want to zoom this out. We're going to take a bars pattern here. And then I'm going to drag this to present day, so bear with me. Okay, let's take a look at this fractal. So not perfect because of time frame. And by the way, the reason why is because there's more money in these markets, so it takes longer time for these fractals to play out. It takes longer time for the market to move, right? And I've explained this, you know, using law of large numbers before, right? Like $100 to double $100, you just need $100, right? So a 100% increase on $100 is just $100. Easy. $1 million. A 100% increase on $1 million is another $1 million, right? It's a lot harder to double your money if you have $1 million than if you have $100, right? $1 trillion, blah, 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 right? So these markets take longer to move because there's more money in them. Anyways, I'm going to do my best to stretch this out here. And it's going to fight me. So bear with me a sec. Oh, it's behaving pretty nice. And then we're just going to do something like that so that we can kind of get like the magnitude. Okay. I'm going to line that up. I'm going to line that up. All right. I'm about happy with where that looks. So yeah, this capitulation. For us, you know, it was the financial crisis. Okay. And then you have this run up, and you have an accumulation range, then you have a run up, and then an accumulation range, then a run up, and then an accumulation range. You know, for the Dow during the Great Depression, it didn't see the COVID crash or whatever, but you know, I'm sure after seeing this play out over a decade, people were pretty convinced that they were in an infinite bull market. And what I'm concerned about is that, you know, maybe we're here in that accumulation phase, or maybe we're like here in that accumulation phase. My speculation is that this still ends in a blow off top. And the reason why is because when your money supply looks like this, how could it not end in a blow off top? Right? Like, it needs to be like complete excitement. And hopefully this take doesn't age like milk. Like, I hope somebody in 2030 like doesn't look at this and be like, he didn't realize that like he was in, you know, the bubble popping. He thought there was more time left. But like, I assume, you know, like the Great Depression, like the dot-com bubble, right? Like, everybody was in this like area of just peak euphoria where it's like everybody thought the markets could go up and up and up and up and up until they didn't. I don't think we've hit that level of euphoria just yet. And the reason why is because people have been like cautioning of like the end of times for this bull run, the end of times for the stock market for years now. Nobody's like fully bought into the euphoria, I think. And I think the reason why is because they have scars from, right? Most of the people that you hear the loudest about this are doing two things. They're forgetting that we added 50% to our money supply in the past 2 years, right? All US dollars in current existence, half of them have been printed in the past 24 months. So that's one thing that we're forgetting. The other thing that we're forgetting is important is that like there are people that are like not that old that lived through this, right? They lived through the tech bubble and they have wisdom to offer as a result because they thought infinity bull run, party time, never going to stop until the blow off top happened. And they were holding a bag for literally a decade. And those people that are bearish, they're not mean, they're not evil. They don't want you to hold the bag for a decade, right? Because that sucks. And so when I look at this market structure, and you know, and let's, I know we're looking at the Dow, and we'll go back to the Dow, but let's, you know, pull the fractal here too. Why not, right? And it's like, I want like a nice like capitulation to pull this off of. Let's do right there. That looks good. All right, financial crisis. I mean, look at how crazy, and I'm going to extend this like I did with the Dow. We're going to line it up nice and pretty. I mean, look at this, right? Same thing. Run up, accumulation range. Run up, accumulation range. Run up, accumulation range. Run up. And so, like, you can make two arguments here. Diminishing returns, right? Like, we're not going to get the same return on investment as we did in a blow-off top from the tech bubble. Which, by the way, that's fine because that probably means the subsequent bear market's not going to last a decade, right? But the other idea here is that if we're going to head into a multi-year depression bear market, I just personally don't think like now is the time, because we were pretty euphoric this past year, but I don't think euphoric in that sense, right? We were screwing around with meme stocks and stuff like that. And we had a bunch of money, liquidity injected, which people are naturally going to act dumb about. But I don't know, like, look how freaking, and again, these are just fractals, and I'm literally bending this into a shape that fits my narrative better. So, feel free to ignore me. But like, I mean, look at those, like how all these tops even kind of line up, right? Like, top there, top there, top there. And, maybe we go into an accumulation range down here. During the tech bubble, it went to an accumulation range down here. And then I just think like this, if we're going to head into a multi-year bear market, and it's going to be a blow off top. Let's go back to the Dow. Right? If we're going to head into a multi-year bear market, it just feels like it would be a blow off top. So we'll see. We're in a bear market right now. There's no doubt about that. Is it going to be the one that, gives everybody for the past decade a reality check and like comes down and does something like this and takes forever to go back up until, the end of the decade? I don't know. I don't know if that's totally going to be the case. I think we printed so much money that it's hard to do that in the first place. I think that's what like everybody's forgetting is the base, right? The literal denominator that we're measuring everything against has doubled in a very short amount of time. So like if this bubble pops and it starts to deflate, like where's the floor? Because it's at least twice as high as everybody's expecting it to be because of the fact that we literally doubled our money supply. The denominator is doubled. So anyways, we're running on 1 hour and 12 minutes. I think most of my viewers are kind of checked out at this point. So I appreciate anybody that's taken the time to sit around and watch and listen to me babble for this length of time. I hope you got something out of it. We talked about some major indexes. We took a look at a couple individual stocks. We took a look at where Bitcoin's at. We took a look at commodities prices. So we basically got through everything I wanted to get through today. So yeah. Also, Michigan homies, any Michigan friends that are watching right now, I will be home next week. So hit me up. But with that, appreciate your time. Hope you guys have a great rest of your week into the weekend, and stay safe out there. Peace.